The price isn't telling you the truth right now, because the real signal is coming from the currency tape and the metal spreads, and they're screaming stress. Gold doesn't jump into the 5,000 handle and just calmly hang out there because the world suddenly discovered jewelry again. Silver doesn't grind to triple digits because everyone collectively got nostalgic about coins. When you see this kind of behavior, big clean air pockets up, fast retracements, then another surge, you're not watching a normal bull market. You're watching a repricing of trust. And the conflict is already baked in. The mainstream wants a single headline, a neat reason, a tidy narrative. The market is doing something uglier and more mechanical. It's moving collateral. It's shifting what it's willing to hold when the ground under the currency starts to feel less solid. And if you understand that, you stop getting hypnotized by the spot quote and you start watching the things that actually force price discovery. Because here's what almost nobody wants to say out loud. Panic doesn't arrive with sirens. It arrives as small, rational risk adjustments made by institutions that cannot afford to be wrong at the same time. And metals are one of the first places that shows up, especially when the dollar stops acting like the unquestioned center of gravity. Now, let's anchor this in what the tape has actually been saying. We've had gold printing record territory north of 5,000. Depending on the feed you watch, you've seen it around the low to mid $5 200s, and you've also seen it spike dramatically higher into the $500 area in reaction to the latest macro catalyst. Silver, meanwhile, has been trading in the triple digits, with quotes around the low 110s per ounce. Those are not normal times numbers. And if your instinct is to immediately ask, is this sustainable? You're asking the wrong first question. The right first question is, what mechanism makes the market pay up this aggressively right now? Because that's where the real pressure starts. And the answer starts with the dollar. Not in the emotional way people talk about the dollar, in the plumbing way. The dollar index has been flirting with levels around the mid-90s, down to roughly the 96 area in recent prints, including a sharp single-day drop that was widely described as one of the worst in months. When the reserve currency starts moving like that, it doesn't just change translation values for multinational earnings. It changes funding conditions. It changes collateral preferences. It changes how much risk leverage can safely carry, and that's the part people miss. The next detail is what flips the whole setup. Because gold in a stress regime isn't primarily a return asset, it's a balance sheet asset. It's the thing you reach for when the future purchasing power of safe cash starts to feel like a political decision instead of a market outcome. And before anyone turns this into cartoon conspiracy, let's keep it finance literate and legally sane. You don't need a shadowy plot for this to happen. You just need incentives. You just need risk managers and central bankers and sovereign allocators and dealers doing the exact thing their mandates push them to do when uncertainty rises and the currency path looks less anchored. So here's the hidden detail that reframes everything. This isn't just a metals rally. It's a collateral migration event wearing a gold costume. When credibility wobbles, around policy, around fiscal discipline, around central bank independence, around geopolitical alignment, institutions don't necessarily panic buy because they're emotional. They rotate because they're forced. They don't want to be the last one holding the thing that can be diluted, devalued, or politically pressured. And in that world, the metals market becomes a pressure valve for the currency market. Now add the why now calendar trigger, because timing matters more than people think. You're not watching this in the middle of a sleepy quarter with no catalysts. You're watching it in a window where flows become mandatory. Policy week, month-end positioning, and a market that's just been reminded very loudly that central bank decisions are not happening in a vacuum. This week's narrative shock wasn't just rates held or rates cut or whatever your favorite simplification is. The deeper shock is that monetary policy is being interpreted through a political lens, and markets hate that because it makes the reaction function harder to model. And when the reaction function becomes a question mark, risk budgets tighten, liquidity thins, and then the moves get bigger. But that's not the part that matters. What matters is what happens in the structure, because spot price is the headline. Structure is the truth serum. So let's talk structure in plain English without turning this into a lecture. Metals trade in layers. There's the futures market, levered, fast, liquid, where large players can express views with margin. There's the options market, where dealers have to hedge and where gamma can turn a move into a cascade. There's the OTC and physical market, where actual bars, coins, and industrial demand live, and where scarcity shows up as premiums, delivery timing, and no, we can't get that size right now. These layers don't always agree in the short run. When they disagree, the disagreement is the signal. If you only watch spot and you ignore spreads, term structure, and delivery behavior, you're basically watching a scoreboard with no idea who's actually controlling the ball. And in stress regimes, the ball is often controlled by forced flows. Here's one of the cleanest tells: term structure. In metals, you can look at whether the market is paying more for immediate delivery versus future delivery when the front end starts pulling harder, when nearby contracts are more bid relative to later ones, that's the market saying, I want it now. That can be a sign of tightness or a sign of hedging urgency or a sign of funding stress where the carry trade breaks down. And the reason it matters is mechanical. When the market pays up for now, it punishes anyone who is structurally short near-term supply, and it rewards those who can deliver. And that's where the squeeze potential starts. Now, inventory is not inventory. This is one of the most important psychological traps retail falls into. People see there's plenty of gold in vaults and assume scarcity is impossible. But the market doesn't trade total metal. It trades deliverable metal, available metal, metal that meets specifications, metal that can move through the pipeline on time, and metal that isn't already spoken for. A pile of metal that exists but can't be delivered against a contract on schedule might as well be on the moon for price discovery purposes. And that distinction, deliverable versus non-deliverable, is what turns a comfortable narrative into an uncomfortable reality. Then you have delivery behavior itself. When stress rises, the market starts caring more about whether someone takes delivery, rolls, or cash settles. You don't need to know every technical detail to understand the intuition. If more participants start insisting on the real thing, it tightens perceived supply and forces the paper layer to respect the physical layer. And if the physical layer is even slightly constrained by logistics, by refining bottlenecks, by bar size mismatches, by regional demand, price can move far faster than the but there's plenty of metal crowd expects. Because if this one level breaks, the math changes. Now let's bring silver into it, because silver is the tell that this isn't just a calm, orderly store of value story. Silver behaves like a margin instrument. It's thinner, it's more volatile, it's more sensitive to positioning. And when silver explodes, it often means one of two things. Either speculative demand is going wild, or shorts are getting forced to cover into a market that can't absorb it smoothly. And in a world where funding and collateral are the real story, forced covering is exactly what you expect to see. Think about how this works in practice. A leveraged participant is short silver or short gold through futures. The market rips against them. Their margin requirement rises as volatility rises. Their mark-to-market losses increase. They either post more collateral or they reduce exposure. If they reduce exposure, they buy back shorts. That's not a choice, that's risk management. And when multiple players do that at the same time, price accelerates. The move feeds itself. Then, because humans are humans, late money shows up chasing the candle. And the market, being the market, punishes late money with a sudden downdraft. That downdraft isn't the end. It's the mechanism shaking out weak hands and resetting leverage. And that's where the real pressure starts. Now layer in options, because options are the hidden engine that can turn a big move into a ridiculous move. Here's the clean version. When traders buy calls aggressively, dealers often end up short those calls. Being short calls means the dealer's risk increases as price rises. To hedge that risk, dealers buy the underlying futures or related exposure. That buying can push price higher. As price rises, the dealer may need to buy more to stay hedged. That's delta hedging. And if the market is in a zone where gamma is high, meaning the hedge requirement changes rapidly with price, dealer hedging can become a feedback loop. The market goes up, the hedge buys, the buying pushes it up more, which triggers more hedging. It's reflexivity with a math badge. Does that mean every rally is a gamma squeeze? No. But in a thin, nervous market around key strikes and key levels, options can absolutely be gasoline. And when gold and silver are already being bid by macro hedging and currency stress, options can amplify the move beyond what fundamentals alone would justify in the short run. But that's not the part that matters. What matters is what happens after the squeeze impulse. Because that tells you whether this is a one-off panic candle or a regime shift. A one-off candle fades quickly and structure normalizes. Spreads relax. The dollar stabilizes. Volatility compresses. The market stops paying up for immediacy. A regime shift does something different. It holds a higher floor. Pullbacks get bought faster. The bad news stops hurting. The market shrugs off reasons to go down. And most importantly, the currency tape stops acting like a safe anchor. So let's talk about the currency signal in a way that actually helps you. The dollar isn't just down. The dollar is being interpreted. When the market sees political pressure, fiscal uncertainty, and shifting global relationships, it starts thinking in terms of risk premium. And a weaker dollar can be self-reinforcing for commodities because commodities are priced in dollars globally. If the dollar weakens, dollar-priced commodities often need a higher nominal price to clear the same real demand. But there's a deeper layer. A weaker dollar can also trigger a rebalancing impulse from global holders. If you're a reserve manager and you're watching the currency behave erratically while the political temperature rises, you don't need to hate America to diversify. You just need to reduce single point of failure risk. And that kind of flow doesn't scream, it grinds. Then it suddenly shows up in a week where liquidity is thin and positioning is stretched. And the move looks like a surprise. It isn't a surprise. It's a schedule. And that brings us back to the calendar trigger. Markets love to bully you around month-end, policy week, and options expiry, because those are the times when flows are less optional. Funds rebalance, dealers roll hedges, CTA models update exposures, risk parity adjusts based on realized volatility. That's the quiet machinery. And in a metals market that's already tight, already emotional, already sensitive to currency weakness, that machinery can become a battering ram. Now, here's the part where skeptics usually push back. They say, if the Fed held rates, why is gold exploding? Shouldn't higher rates be bad for gold? That's a good instinct. It's also incomplete, because the relationship between rates and gold isn't a simple on-off switch. It depends on real yields, inflation expectations, and most importantly, confidence in the policy framework. When people believe the framework is stable, gold trades more like an opportunity cost asset. When people doubt the framework, gold trades more like insurance. Insurance demand doesn't disappear just because the premium is higher. In fact, sometimes insurance demand rises because the premium is higher, because the premium itself signals higher risk. That's the irony. The next detail is what flips the whole setup. And the next detail is credibility. If markets start believing that central bank independence is under pressure, even rhetorically, that can change inflation expectations and currency expectations in ways that overwhelm the simple rates up, gold down meme. It doesn't have to mean runaway inflation tomorrow. It just has to mean the distribution of outcomes got wider. And when the distribution widens, hedges get bid. Now, let's stack proof the way a serious investor should. No single argument. You want layers? Layer 1 is price behavior. Gold holding above 5,000 with violent reactions to macro headlines is not normal. Silver holding triple digits with high volatility is not normal. Layer 2 is the dollar. DXY moving down into the mid-90s zone is not the dollar flexing. It's the dollar being questioned. Layer 3 is macro context. Policy uncertainty and political pressure create tail risk. Tail risk bids insurance. Layer 4 is market structure. Options hedging and leveraged positioning can force buying mechanically, especially around key strikes and key levels. Layer 5 is physical versus paper tension. Even modest friction in the physical pipeline, delivery timing, premiums, availability, can magnify price when paper is already stressed. Layer 6 is behavior. In stress regimes, pullbacks become faster because no one wants to be underhedged. That's a proof stack. And it matters because it tells you what to watch next instead of what to believe. Now let's talk about levels, because everyone wants levels, but most people use them like astrology. In markets like this, levels aren't magical. They're where the forced flows change direction. They're where liquidations stop or start. They're where dealers' hedges flip. They're where large players decide whether to defend or retreat. For gold, the obvious psychological zones are the big round numbers, 5,000, 5,2, 5,5. For silver, triple digits create their own gravity. The zones around $100 $110, and the recent highs are the obvious battlefields. Silver can rip $500 to $10 in a blink. In a regime like this, that doesn't invalidate anything. It's the nature of the instrument. But the character of the pullbacks matters. Does it snap back quickly after a flush? Or does it grind lower as liquidity returns and leverage gets reset? That's the difference between continuation and consolidation. And now we do the honest part that keeps you from getting emotionally hijacked. 2 scenarios. Scenario 1 is the controlled pullback and retest. This is the healthy version, even if it doesn't feel healthy. Price pulls back sharply, headlines declare the move is over, commentators dunk on late buyers, and sentiment flips bearish right when the structure is resetting for another leg. The key confirmation in this scenario is that pullbacks hold above prior breakout zones, and rebounds happen quickly with less drama. The invalidation is a breakdown that doesn't recover, where bounces get sold and the market starts making lower highs and lower lows. Scenario 2 is the continuation squeeze with gap risk. This is the violent version. The market doesn't give you a neat retest. It keeps running because forced buying overwhelms liquidity. Options hedging adds fuel. Shorts get trapped. Funds that were underweight chase. And the risk is just that you miss it. The risk is that you get chopped to pieces trying to trade every wiggle. The confirmation here is simple. Price keeps holding above key zones, and every dip gets bought faster than your brain thinks is reasonable. The warning sign is widening intraday ranges and sudden air pockets, because those are the fingerprints of forced flows. But that's not the part that matters. What matters is how you, the viewer, survive this without becoming exit liquidity. Here's your psychology shield, and I want you to actually use it, not nod at it. In markets like this, volatility is a weapon, not a conspiracy weapon, a structural weapon. It's used by the market itself to force bad decisions. It does 3 things. First, it creates urgency. You feel late, you chase. Second, it creates regret. It whips against you, you panic sell. Third, it creates paralysis. You swear you'll wait for confirmation, and confirmation arrives as a price you can't emotionally buy. The antidote is not prediction, it's process. You need to separate trend signals from noise. Trend signal is the market holding higher floors and respecting key zones. Noise is intraday chaos, headline spikes, and social media certainty. You need a time horizon. You need sizing you can live with. And you need an invalidation level that's mechanical, not emotional. Because the truth is brutal. Price can whip around violently, even if the thesis is correct. You can be right and still get wrecked if you size like a gambler. That's the difference between being correct and being solvent. And that's where the real pressure starts. Now let S translate all this into a practical what to watch next roadmap for the next week or two. Not a prophecy, a checklist. Watch the dollar's reaction function, not the day-to-day tick, the reaction. When bad news hits, does the dollar still weaken? When good news hits, does the dollar fail to rally? That asymmetry tells you whether confidence is damaged. Watch whether gold and silver treat dips as invitations or warnings. If dips get bought quickly and price reclaims levels fast, that's strength. If dips bounce weakly and roll over, that's exhaustion. Watch volatility. Rising volatility can be bullish in a squeeze phase, but it can also be the sign of distribution. The key is whether volatility spikes are followed by higher lows or lower highs. Watch structure. You don't need a terminal to understand it conceptually. Does the market keep paying up for immediacy? Do you keep hearing about tightness, delays, premiums, and procurement urgency? Does the physical conversation get louder? Those are the symptoms that the paper layer is being forced to respect the physical layer. Watch the calendar. Liquidity is not constant. Weekends, month-end, and major policy communications create gaps. If you're positioned, you respect gap risk. If you're not positioned, you don't chase gaps. You wait for structure. And keep an eye on the narrative whiplash. The louder the certainty gets on either side, this is the end, or this is guaranteed to go vertical, the more likely the market is about to do something that humiliates both camps. But that's not the part that matters. The part that matters is whether this is a durable repricing of trust. If the dollar continues to behave like it's losing narrative control, if the policy framework continues to look politically noisy, then gold's role as balance sheet insurance stays relevant. And silver, being the thinner, more levered cousin, will continue to exaggerate whatever the underlying pressure is. That doesn't mean straight up. It means violent up with violent down, because that's how leverage unwinds and rewinds. And now, let's address the institutional skepticism head on. People love to say metals are manipulated, and then they stop thinking. Here's a better framing that keeps you grounded. Metals are heavily intermediated. Banks, dealers, exchanges, and large participants manage risk through hedging, inventory, and funding. That can create price behavior that looks like suppression, selling rallies, capping moves, triggering stops, without requiring a villain. Often, it's simply the market's plumbing doing what plumbing does. It reroutes pressure. When price runs, liquidity providers widen spreads. When volatility rises, margin requirements rise. When margin rises, leverage shrinks. When leverage shrinks, positions get cut. These are mechanical loops, and when you understand them, you stop taking every pullback personally. So where does that leave us right now? It leaves us in a market that has already told you it is willing to price gold above $5,200 and even lunge toward the $5,500 zone when macro stress hits, while silver is comfortable trading above $100 with bursts into the 110s. It leaves us with a dollar index that's been living around the mid-90s after sharp declines, which is not the backdrop you expect in a serene, confident global system. And it leaves us with a calendar where flows and positioning are still being forced to reset around policy, communications, and month-end mechanics. That combination is combustible, not because it guarantees anything, because it creates conditions where small triggers produce large moves. So here's the way I'd keep it honest. If gold holds its new floor, if the low $5,200s area behaves like support rather than a temporary perch, then the market is signaling that this is not just a headline spike, it's an ongoing repricing. If gold can't hold it and repeatedly fails to reclaim it after breaks, then the move is likely digesting, and silver, because it's silver, will probably punish both bulls and bears during that digestion. On silver, if the market keeps defending the triple-digit psychological zone and snaps back fast after flushes, that's continuation behavior. If it falls back below those zones and struggles to reclaim them, that's the market telling you the squeeze energy is cooling. Cooling doesn't mean the long-term story is dead. It means the short-term mechanics are resetting. And if you want one metric, one simple anchor that keeps you from getting lost in vibes, here it is. Watch whether the market keeps paying up for immediacy. In plain English, watch whether now is expensive. When now stays expensive, it usually means stress is still in the system. When now cheapens, it means pressure is releasing. The next detail is what flips the whole setup. Because the moment you see the dollar stabilize, volatility compress, and immediacy get cheaper, you're in a different phase. That's when the market stops being forced and starts being discretionary again. That's when the easy part of the move is behind you and the hard part, holding through boredom, begins. And finally, a word about identity, because it matters more than people admit. The viewers who win in regimes like this aren't the ones with the hottest take. They're the ones who can watch a violent candle and immediately ask, what flow created that, and what flow must respond next? They don't need the market to be polite. They need it to be legible. If that's you, if you're here for mechanics, structure, and what to watch next instead of the dopamine of certainty, stay close to this setup. Because the next week or two is going to be less about opinions and more about who gets forced, who gets squeezed, and who keeps their process when volatility tries to steal it. And that's where the real pressure starts.